I think the good thing that happened to probably all three of us is that we launched financing products in the worst economic circumstances since 1971.
I would still say don't jump into entrepreneurship. Do it when it is eating you alive and you are finding a gap that no one else is addressing, or you don't believe anyone is going to do it in the way that you think it should be done.
My friends will hate me for this, but I think you can shut down some club and Punjab club and boat club perhaps, and probably some of these bankers will have more time to allocate capital into.
But do you think it's a time? It's not a time constraint.
Into active sort of pursuits as opposed to treasury bills and sukuks.
I say this to every investment banker, and at that time as well, you know nothing about operating a company just because you've invested in a company. You may look like a hero, etc., because you've invested in successful companies, but you know nothing about operating a company. And I knew that. I understood that.
Where are the opportunities? Like Abhi exists, Haball exists, Creditbook exists, and Omair is now starting a new company. In this space in Pakistan, where would you say are the opportunities?
So you just wake up and you're like, hey, shall we?
Thanks so much for coming here, guys. I've been meaning to do this for a while. The idea behind this series is to create information sources and inspiration sources for young entrepreneurs in Pakistan. जो भी इस वक्त पाकिस्तान में एक 24 या 25 साल का स्टूडेंट है या भी यंग एंटरप्रेन्योर है जो चाह रहा है कि वो एक बिज़नेस स्टार्ट करे और उसके लिए वो फाइनेंसिंग ऑब्टेन करे या उस बिज़नेस को किस तरह बढ़ाए, द आइडिया इज़ कि दे कैन लर्न फ्रॉम यू गाइस टुडे. सो विदाउट टेकिंग एनी मोर टाइम, I'd like you to start by just giving a very brief introduction of how you got to where you are and why is it that you are choosing to solve this problem.
Yeah, so I started basically working for the Federal Board of Revenue. So
ये किस साल में था?
This was 2008 to 2012.
पर आप पैदा पाकिस्तान में हुए थे?
मैं पैदा कराची में हुआ था, schooling भी सारी कराची में, everything in Karachi. But my first job was working for the government in trying to automate their customs clearance process. And that obviously had a very large canvas in terms of impact that the entire trade now moves through that system. And from there on, you started seeing the economy, the way it moves and how small traders, big traders, large manufacturers, importers, commercial traders, how they transact for trade. From there, I got called back again, and then I had a 4-year stint with Sabre, where I was working for an airline solution provider, again on the airline operation side. But I got called back again to do something very interesting, which was how you pay your taxes today online, where you can make a digital payment. And that was something that I helped them build because of my background with customs. And it's at that point that I realized that it's, the B2B leg of payments is missing in the country. Now, this had nothing to do with financing. Financing actually happened during Haball. But Haball basically started with just trying to automate supply chain B2B payments because I felt nobody was addressing that. You had OneLink and you had IBFT and you had bill payments for K Electric and Sui Gas. But there wasn't anyone trying to solve B2B payments for companies like Angro or Coke or Pepsi or something like that.
If I was to ask you कि अगर आसान लफ्ज़ों में समझा सकें कि Haball करता क्या है? Exactly.
So आज सिर्फ 3 काम करता है. पहला काम यह है कि किसी भी large corporation की payments को digitize करते हैं. We can pull their electronic invoices. We can debit any bank and settle into the recipient's bank, and then reconcile these transactions. And we do it instantly on a real-time basis. Once we have enough data on their invoice and payments data, then we're able to partner with any of the financing providers, largely Islamic banks or Islamic windows, and then to be able to finance those invoices. So that's the second thing that we do. And something that we just recently started, it's still in the process of being rolled out, is that we're also going to now pick those invoices and report it to FPR for electronic invoice, the compliance of their sales tax reporting in real time. So these are the 3 things that we do, but we like to call ourselves a supply chain aggregator that does invoicing, payments, and financing. So yeah, that's the journey. And somewhere in the middle, I always thought that financing could just not happen if you don't have the payment and the contextual data that comes with the payment, because that's the real proof that this organization actually breathes and lives and their income assessments. So that led to the financing piece that we then launched back in 2022.
By the way, sorry, one
Yeah.
question.
Yeah.
Haball. How did you come up with the name?
So it's Arabic actually, it's pronounced as Habl. And you can't say bal, it's in Arabic, it's called adgham, which means when you join two words. So it's Habl.
Habl,
And
okay, fine.
it comes in the Quran in several occasions, but the more popular ones is, every time there's a sectarian issue in the country and then like 4 Maulvis from different schools of thought will just sit and they say, wa'tasimu bihablillahi jamia, that hold fast the rope of Allah. That rope of Allah is hablullah, the rope.
Oh, okay.
It's anything that connects two things. Then there another occasion in the Quran, and Surah Kaf, it says, Nahnu akrabna min hablil warid. We are closer to you than your jugular vein. The word for jugular vein, hablil warid, is that word. So I picked it up from there. It's habl. But of course, when you write it in English, it sounds like habl. So yeah, so that's how it came into being. Yeah.
Great. So Omer, how's your journey?
Yeah, slightly different. So wasn't born in Pakistan. I was born in London. Parents from here, but moved abroad younger. Lived in about 9-10 different countries while growing up. And professionally, I was in investment banking for about 16 years, both buy side and sell side, and covering emerging markets always. So I think continued the tradition of moving around. So even while I was working, I lived in almost 8-9 different countries all the way. But really, the journey into Abhi happened, or at least the stepping stones was when I lived in Africa. The firm I was working with at the time, Rencap, we were one of the first firms to basically put together a syndicate of investors for fintech before it was fintech. So we did like Safaricom, for example, in Kenya, and then Bcash in Bangladesh, and continued down that road. Was an investor then, moved to New York, and was basically running a fund focusing on this segment. Sat on the board of our largest investor as well, which invested in early stage companies.
Who's your largest investor?
Vostok Emerging Finance, VEF.
Yeah.
And so, yeah, sitting in New York, but traveling all over the place and seeing various businesses like ours now, similar, being built in places at that time where everyone said it can never happen, it won't happen, and it did happen. And then I saw Pakistan as kind of a place that everyone neglected. And so it turned into something where a bit of pattern recognition is saying, look, Pakistan, don't compare to India, don't compare to China, those are like beasts in themselves. But places like Egypt, look at Indonesia, look at Mexico, for example. I think synonymous countries where you've seen fantastic fintech being grown from a credit-led perspective, so that's where we're focused. That took me down the path of saying, well, I think there's something that can be done over here. And yeah, threw the hat in the ring to be an entrepreneur to try and build something with a credit focus. And then decided to
So what year did you decide to start Abhi here?
I resigned in end of 2020 and moved to Karachi with the family February or March 2021.
Right after COVID.
Right, during COVID.
During COVID.
During
actually,
COVID.
yeah.
So yeah, when we did our YC batch, for example, it was all remote because we started the business on the day of the batch. So it was really good because Ali and I.
Ali is your co-founder.
Oh yeah, Ali, my co-founder. we would work during the day, which were long days, and then come back, and this batch would start at 12 a.m. and finish at 4 a.m. So you take your real life learnings, go into the batch, and then kind of build from scratch from there. So yeah.
So in 2021, what were your hopes for Pakistan? What were you looking at?
Honestly, I'll say it, and I tell everyone this: we were very lucky in terms of timing.
Yeah.
So I did have a thesis in terms of where Pakistan could be and why it was neglected, and it was a big part of why I obviously left to be able to launch Abhi. But it happened a lot. It did not happen. The investor appetite, thinking it happened, came to fruition a lot quicker than I thought it would.
Okay.
What I mean by that, it was the tail end of the global boom, and typically in that cycle, you'll always have tail end of risk cycles. You'll always have the smaller markets suddenly become more interesting and attractive because everyone says, okay, pattern recognition, therefore 240 million people. I remember getting on those calls with those. People just knew 240 million people.
That's it.
That's it.
Yeah.
And people were writing checks saying, yeah, 240 million people, the opportunity is massive. I'm like, that's all you know about the country. And you never stepped foot into this part of the world, let alone Pakistan. And that's the basis of it. So, sorry, to answer your question is, the realization of the world happened a lot quicker than I thought it would, but the overhype happened also, unfortunately, it coincided with that. So we were very lucky in terms of coming here, going after what we were, but then being able to raise at the pace we did was only because the world was in the right place and looking at Pakistan at that time. But from an infrastructure perspective, in terms of everything else, still a lot of work to be done. However, the basic premise was that. I mean, think like OneLink, for example. That did not even exist in other emerging markets. Yeah. So when I saw that OneLink, and that was a big part of when we launched, I said, when Raast came along, for example, I said, but we don't really need Raast, to be honest. We've got OneLink. It's ₹1 a transaction. Really, do you need another payment system when you've already got a fantastic payment system? Then there's obviously technology upgrades to happen. But I'd say infrastructure-wise, what surprised me was that it was ready. The base was set. Now it was time to build on that for use cases for businesses in Pakistan.
So Hasib, you can start now.
Born and raised in Karachi. I think for me, I'll just talk about like what I feel like were defining moments that kind of led me to over here. When I look at both like Omer and Omair, I think that, man, these are two entrepreneurs like sitting in front of me that were very intentional through their experiences in figuring out how to carve the market for themselves. I think that's where maybe I differ a little bit, which is a bit more of youthful naivety
We need some of that.
and like just bumbling and sputtering into things. But I think like where it really kind of came down for me was my first job was at Dawn.
Okay.
And I was like working many projects I got involved in, but I think one that I really enjoyed, which was around election analysis for 2013 election, and then the by-elections that happened afterwards as well. And that kind of got me into like a lot of constituency level data, both first-hand, second-hand data. And from that, I kind of saw a little bit of pattern recognition at that time, which was when we went in, and you can talk about the political system as however you want to, but when we kind of went in and we kind of understood like constituent behavior, we kind of understood that when we looked and interviewed or saw data that represented the bottom of the pyramid, and then we looked at data that looked at like what was at a time a very burgeoning middle class for Pakistan, there were like two notable factors in terms of the differences between those two lifestyles. And it became apparent that where transport and financial services were affordable and accessible, could kind of see like nearly a catapulting effect between moving from the bottom of the pyramid to the middle class. And so that became like just something that was just like gnawing at me. Eventually started a bike sharing company first.
So do the transport thing. Like that was your thesis
That
initially?
was the area. And so we leased these electric bikes from like China and stuff like that. And
What
we were
year
like,
was this?
And this was back in 2015.
Okay. Oh, wow. Electric bikes back then.
It's funny, like within our investor I2I, there's a company called Easy Bike. We were actually called Easy Bike then. And
Oh,
stuff.
no, really? Wow. Did you have the trademark? I can get you paid by the
And yeah, so that was an incredible experience. And I think like, when I meet Rafiq and Munib at Bikeia, they were building the business at a similar time. And I think our lack of experience was why we didn't continue on. Like, so we had like different threats from large manufacturers as well as some of the local transport mafia. And at some point we just got a bit jittered out and, we developed inertia. Whereas those guys, they just pushed on through. They knew how to kind of operate. But yeah, moving from there, started to get much more involved in financial services, did consulting in London as well. Got involved with Taze early on, which is a nano lending company that's now acquired by Zoodpay. That was a great experience at a consumer level. That insight actually kind of drove me, Omer Bhai talks about the B2B payments, like how it was missing. For me, I was just wondering that, again, because Pakistan still, Omair talks about infrastructure. At that time, a lot of the transactions were over the counter, right? And so I was just like, where our consumers or our borrowers are going over the counter to these merchants, but why aren't these merchants getting digitized and like uplifted? And that was my real insight. And I was looking at it more from a point of view of there could be a much better user experience over here for the merchant. And then, just bumbled and started into kind of Creditbook as a result. And that's basically.
So what is Creditbook doing right now?
So Creditbook, right now, we are a lending company in Pakistan. We have 4 channels where we kind of lend through. We help non-fintechs start off with lending services. We help fintechs build out or either carry out their loan operations through our systems. And then we have our own kind of proprietary channels for doing, let's say, direct e-commerce lending and other segments.
Okay, cool. So all 4 of you somehow stumbled upon, or not just stumbled upon, just
that's just me.
all 3 of you. Sorry, all 3 of you.
Like, who's the 4th?
I was the 4th one. My clients are also SMEs. But all of you guys picked this space, like the SME finance. So can one of you just explain to me the opportunity? Like, why is this a big opportunity for multiple companies to be going at it? Just with data or numbers?
I'll take a very holistic view on it, and then someone else can jump in. For me, it's very simple. You look at the GDP of Pakistan, and you look at contribution of SME to GDP. It's north of 70%. However, you look at SME, and for us specifically, we're a credit-led fintech. You look at SME credit to GDP, it's amongst the lowest in the world.
Yeah.
So basically, you're saying your bedrock of the economy has no lifeline which happens constantly, and not just in Pakistan, but emerging markets in general, in Pakistan specifically, during economic turmoil. Right? You look at typical cycle of the economy in Pakistan, it's 4 years, if you're lucky. And boom, bust cycles happen.
Yeah.
And so your GDP inflection point that happens at every 4 years is massive and vast. Now, the big difference between developed markets and emerging markets is that in that spectrum, when you have that downfall, the availability for capital, I'm not saying, even the US, for example, it's not been fixed in terms of SME access to credit. However, it's been addressed to the degree where, I'll give you an example, during COVID, for example, the likes of Block, et cetera, were all being used as conduits to be able to send stimulus money to small businesses.
Yeah.
So when you have that cash crunch, because really all you need to do as a business in these markets is come out the other side alive, right? And businesses die in these cycles in Pakistan. And so the thesis for us is very simple, saying that if the bedrock of the economy does not have access to the basic material they need for them to come out the other side, and there are good business and good operators that just had bad luck, then if you can support that infrastructure, and given that the vast majority of the economy is there, there's enough room for 40 of us, and we still wouldn't be able to scratch the surface. So that was one aspect. And even in countries like Brazil, so Brazil has a credit to GDP much higher than Pakistan, even SME credit to GDP. And when companies like Creditas, for example, came around, early days, everyone said, why? There's already close to 90, 95% credit in GDP. The banks are working fantastically. There's no room for extra credit in the system. It ended up being farcical. They now run their loan book is something like $6-7 billion a year.
Okay.
And that's in a span of like 8-9 years they've been able to build that at a time when everyone said there's no opportunity set. So for me, the view was that, and for Abhi at least, was that this is a massive opportunity that no one is touching. And even if people come in and touch it, there's a room for many of us to be able to play.
How big would you say the market is generally, like if you were to put a number on it?
I wouldn't.
You wouldn't?
I wouldn't, because it's so informal. There is no numbers. The problem is with all these numbers, and this is where the breakdown happens in true form, and I think this is why Pakistan gets overlooked. A lot of other countries will have a beautiful World Bank report on what the SME sector looks like. Not that it doesn't exist for Pakistan, but this is an informal, undocumented economy. I mean, the companies that Hasib is touching, the companies that you're touching, there is no documentation. The companies that we touch, like 99% of the customers that borrow from us have never accessed formal credit in their life. So where is the history? Where is the credit bureau? We're creating the credit bureau for this. So if it's undocumented, how can I put a number on it?
So when you say undocumented, I'm thinking the person, even all their accounting and all the entire book is not something that like they can share, right? They're not paying taxes. They're in the dark part of the economy. And then there is people who are operating fine. They have a legitimate business. They're paying taxes, but they've just never accessed credit, right? So there are two different sets. How do you solve for the undocumented part, like the part that has never accessed credit? Or never don't have their books in order. Yeah.
I think that's why I think Omer will keep emphasizing that why it's important to be credit-led, because the incentives align when you are credit-led. For right now, with how costly it is for some businesses to be documented, the incentives do not make sense to be documented and have, a bank account and then cards and so on and so forth. So, interestingly, you'll see in developed markets, and investors sometimes look at this prism and they go and they think, hey, Hasib or Omer, why are you starting with a credit product? Why don't you start off with bank accounts and then move into cards and so on and so forth? It's because, to what Omer was trying to emphasize, is that these businesses, the only way they're ever going to come into the formal economy is if they get that access to credit. Otherwise, it's too costly because of the taxation. It eats into their margins. The margins are, let's just say for a distributor, like roughly 8%. The sales tax over there is just nearly twice as much of that. Then if they do not create leverage within the system, it doesn't make sense for them to ever get documented. So I think, how do we solve for that? I share Omer's kind of thesis about being credit-led over here.
Can you explain credit-led, the term?
So I think from my lens, it just means when you are a financial services company, your primary entry point is a lending product.
Okay.
And then you can graduate to other types of, whether it might be a deposit product or a savings product, etc.
Yeah, I think the way I'm looking at the market right now, let's say if you're a 110 trillion rupees GDP, typically 5 to 10% is the leveraging opportunity in any economy. And that cuts across the entire sort of corporate sector, vendors, suppliers, service providers, distributors, retailers, all of that. That's what typically is the MSME. MSME is a supplier or a manufacturer or a distributor or retailer. That's who they are. Just within the supply chain space, when it's a domestic trade opportunity, when they're either a supplier to a large manufacturer, or they're a distributor of a large manufacturer, or they're a retailer of a large manufacturer, just this segment is probably 1.5 to 2 trillion rupees. Okay. So with that sort of logic, if you just extrapolate, I think at best this is like a 10 trillion rupees opportunity for MSME credit. And right now where we are is about 500 billion rupees. State Bank has given a target for doubling it up for the next, I think, 5 years. So of course, there's a lot of room over here. I completely agree.
So we're like 1/20th of what it could be.
Yeah, and the regional numbers are probably the worst that we have. I mean, the whole region is depressed, but we're like half of our regional average as well when you compare us to the SAARC nations.
Why would you say that is?
That's well, there are multiple reasons, and I mean we can make jokes about it as well. Recently, someone sort of posted this on LinkedIn. Is like, how do you fix that? I said, you can, my friends will hate me for this, but I think you can shut down Sindh Club and Punjab Club and Boat Club perhaps, and probably some of these bankers will have more time to allocate capital into.
But do you think it's a time? It's not a time constraint.
Into active sort of pursuits as opposed to treasury bills and sukuks. So yeah, I think it's largely intellectual laziness on the part of some very successful banks. That's one reason. And then of course the MSME, there is a lot of defogging that's required before you can actually go in and start lending, because at the end of the day, whether you're using your own equity or you're using a line from a bank, it's still capital that you have to deploy very smartly. none of us want, NPLs on our portfolio. And as a result, when you start deploying that, you have to figure out a way to defog this. And the first thing is that, the way you mentioned it, are those MSMEs documented? Are they paying their taxes? Do they have a general ledger? Do they have a P&L? So you have to pick. Now, he'll figure out one angle of trying to defog it. He'll figure out another angle. We figured out another angle, that we're looking at the supply chain. We're looking at their buying cycles to determine what they can sell. Everyone has these different hooks in trying to figure out how do you assess his ability to generate income and to be able to pay back. And there are multiple ways, in emerging economies to solve that riddle. So yeah, the reason why probably the banks have struggled with it is because while the profits are really exciting for them in this segment because they can charge higher for MSMEs, they just find that the risk appetite with their leadership or their shareholders is lacking. And it's just convenient to place it into, sovereign, risk-free deployments.
Yeah, so basically it's just how the incentives...
It's crowding out, right? Yeah. I mean, in economics terms, it's crowding out the private sector.
So government
government says, why would you? Like, you're getting risk-free ROE from one source.
And substantial, it's not a small amount.
No, exactly.
It's like 20%.
Why would I go after this segment? So I'm not incentivized. So I think there are two forms which this happens in countries. It's either one where the incentivization mechanism is there for, because the competition is high enough, that then causes for innovation to come through, right? And I think that's where places like the US, et cetera, that's why it works. Competition is high, so people are constantly fighting to be able to create margin to build business. And that's where you have innovation that comes through. The second, which works more so in emerging markets, is real top-down approach for this from a government perspective. So you look at Malaysia, for example. Malaysia, for a long time, there was a company called GHL Systems, which is publicly listed. It sat flat for many, many years. And all they did was they were a POS company, and they did invoicing and backing, a little bit of lending on it. But the biggest problem in Malaysia, despite it being a much smaller country than ours, was that same problems as Pakistan. No one wanted to become the documented economy. No one wanted the POS machine because then suddenly it become documented. Then one day the government came out and said, that's it, GST is coming in, and any of these stalls, any of these dhabas, etc., that are there and do not have a POS, they're going to be fined through the roof.
So it was an
overnight, GHL, and you look at their stock price now, it's gone nuts, right? It was one of our earliest investments there. And so that's what's really worked in some of these countries. You need national agenda to say, come on, it's time to get this documented.
And actually implemented.
Exactly.
So in terms of national agendas, let's just pick that up and then we'll go back to this sector again. What are the big things that the government, say if you had control of the government, what is it that you would do that could make the biggest impact on this sector?
On MSME lending?
MSME lending, yeah.
I think, so the funny part is that the government has done most of the stuff, and I know you guys will hate me for saying this. I've always argued that the supply side is not a problem. It's just the execution is so bad, and then the continuity that you need to keep on optimizing it so that it scales, we just give up on that. So what do you need? You need someone to cover the risk, so someone can protect you on the NPLs.
Yeah.
The government comes up with schemes and says that we'll give you 10%, 20%, 30%.
What are the current schemes?
So the current scheme is if you're a ME, you get a 10%. The bank will get a 10% risk cover. A 10%. And then if you're an SE, then you'll get a 20%. And before that, in the Ahsan finance scheme, it was almost as high as 50%. Yeah. Oh, wow. That was a very short-lived scheme. But it was also at a subsidized refi rate where the central bank was giving it to you at 1% or 3%, and you had to sell it at 9%. Yeah. And the problem is that, since we're in an IMF program, we weren't allowed to do refinancing because that's against the monetary policy. The monetary policy is saying that KIBOR should be at 22, 23, but then you have these refinancing schemes like export refinance or LTTF or Ahsan's finance or agri credit, where you want emphasis because these are national objectives. Then IMF says that no, this is inflationary and it creates distortion. Now, I don't agree with that, by the way. I mean, because, I think India has been doing a fantastic job at rolling out SME concessionary finance, which is very important. So there are two aspects on the supply side. Number one is who covers the risk, and can the central bank is technically, legally not allowed to own any risk. That's the government of Pakistan or the provincial government's job. So the GOP then owns the 10%, 20%, 30% risk, which they should continue to do that if it's segmented at MSME. And whether you have concessionary finance or not is subject to where the policy rate is. Now at 22, yes, of course you need concessionary finance. Yeah. But now as it starts to go down, it's all right because then it can squeeze into any SME margin. Because the private capital that's available today from his rishtedar or from his community is at 36% or 48%. That's that's a very big margin.
On that, like, do you think Pakistan, given that we, like, even the accounts, the deposits that we do, we put it in like current accounts and not savings accounts. Do you think there's still this appetite to like charge such high interest, like 40%?
That's a very interesting point because you see, all the Islamic liquidity in Pakistan is not subject to what is called an MDR, which is a minimum deposit rate that you have to give your savings customer a certain Kibor minus 1 or 2 rate. That, let's say right now it's 19.5. So if you put it in a term deposit, you have to give them 18. Islamic banks or Islamic windows aren't supposed to do that because they can't have fixed rates. As a result, some of these Islamic banks or Islamic windows have liquidity that's way, way cheaper, and their net interest margin is really high, which technically means that their ability to absorb risk and their ability to make money, because they'll continue to sell it at Kibor plus 1 or Kibor minus 1 or Kibor plus 3. So that margin is huge. Now, of course, you'll see some bankers who will still argue that, no, according to IFRS 9, you have to benchmark it at Treasury. And so we still make that margin that's above Kibor. But at the end of the day, on your P&L, you made a lot of money. Yeah. When you look at a bank's balance sheet and P&L at the end of the year, especially though. So I think that's encouraging, actually. The fact that you have these structures available, that you have Islamic liquidity, that means that Islamic banks and Islamic windows should be able to deploy MSME credit a lot more because they're not struggling with crowding out. Why? Because there aren't enough treasury bills for them to deploy.
Exactly.
Yeah. Right? There aren't enough sukuks for them to deploy. So this is a very nice sort of pocket that's opened up for Islamic banks and Islamic liquidity. And now that the Federal Shariat Court has given a verdict that, you have to convert, however long it takes, however serious they are about it. But I think that's a fantastic opportunity for almost every fintech or any bank for that matter to be able to aggressively deploy MSME credits if they can somehow figure out a good way to handle their NPLs and be able to digitally distribute this credit across the whole country.
Yeah, so coming to that, when you talk about digital distribution, before actual distribution, how do you credit score? Because most of these companies, they don't have data, like their transactions are not recorded. You have to either take their word for it or like, what do you rely on? And I know Abhi has deployed quite a bit so far. What have you guys been, how have you been doing it?
It's invoicing. So look, we do, majority of companies in Pakistan are supply-driven companies.
Okay.
So they're the supply leg. We're looking at invoices on who they're basically supplying to. So that's where the credit assessment starts. They do have a semblance of books that exist, but like you rightly said, some could be makeups. But I think the only area where I'd say is where I think it's on the fintech and where the disruption happens is our goal is not 0% NPLs. Yeah. Mm-hmm. Our band, which we tell our board and our investors, it's not possible. Yeah, it's not possible. Is 4 to 6%.
Yeah. Okay.
I want 4 to 6% NPLs. Because if I have at 0% NPLs, that means I'm not doing my job in terms of actually fixing the problem that's there. Yeah. I will have people and companies that default on me, and that's par for the course. But that's okay, because my profitability in terms of what I'm able to charge will absorb it based on my cost of risk.
And at what percent NPL does it just go out?
I mean, anything above 15%.
Okay.
Is where it just doesn't make sense.
Okay.
But, and look, our window is 4 to 6%. We're sitting there. We've gone slightly higher at times through cycles, but that's okay. But the idea is on a steady state, that's what our absorption capacity is and what we aim for. So I think with certain businesses where the documentation is not there, but you can touch and feel what that business is doing, you are then creating the data source behind it. And I think it goes into what Hasib was saying as well, is we have our own technology for them to be able to use then for us to then document the transactions that are happening. Now, they will not do that unless I say, hey, there's actually, the carrot on this is credit on the other end.
Yeah.
Right? Otherwise, like, why would I use
Yeah,
the
why would you
software?
change what's...
Why would I
what's-
change?
yeah.
I'm happy using my ledger. I'm happy just staying manual. So I think this is the biggest fallacy which is there as well, which I keep saying, is that digitalization and payments, no one is dying to pay digitally. Like, that's not the pain point.
Yeah.
The pain point is like, oh, I wish I could pay this person digitally instead of everything cash. Like,
I
no.
mean, I am, like, because a lot of times I don't want to go and take the cash out.
Yeah,
right?
but you're a rich person. You have a lot of cash. You can,
I don't. I wish that was true.
But otherwise-
the economy is so bad. I'm doing a podcast. But yeah.
But that's really not the pain point people have. It is credit.
Yeah.
So
sometimes there's also some very legitimate reasons why that person would default. Like, in MSME, it's usually a sole proprietor or like two brothers or a father who passes away. I mean, what do you do about that? There's no digital data that you can sort of, I mean, of course you can then start asking for like blood reports and like a health test, but
Yeah.
there's a limit to how much you can be intrusive into someone's affairs. Someone could have like a succession issue that
Yeah.
there are two families fighting with each other, and that happens.
A lot, actually,
Then
yeah.
there could be a lot of real business failures where, they're not able to sell as much as they thought because it's a bad economy, and that's how the business sort of shuts down. So there could be multiple legitimate reasons other than the fact that, the guy was a crook and he really was just trying to run away with the money. That's also there. But even if you get everything right, there is still a problem that a sole proprietor can die.
Yeah.
He could have succession issues,
Theft.
or he could just give up, or he would have theft, or he would have a fire. There could be so many valid reasons, and if you look at central bank policies around that, I mean, it's biased towards the borrower, because then they want to give you the way to either pay back or to even just absolve you of that debt. Then might, as he said, the market just has to absorb it. They have to price it in.
What have you learned in your journey about this? Like, how are you guys determining credit-worthy SMEs?
Yeah, I think the topic about credit scoring is very interesting. I think one thing that, even if, let's just say, the environment becomes such where banks are either not incentivized to lend to the government, I think something that they still will struggle with is just their OPEX relative to this segment.
Yeah.
And how they're kind of set up. So if you look at a bank takes, let's say for a new application on SME financing, will take about 7 to 21 days roughly to go through the entire cycle. Why does it take that long? Because someone, when they're doing the KYC, KYB, so that's the compliance to know who you're lending to, a person will go out physically to do document collection. Now, within that document collection process, there might be times where they've gotten the right documents, or you'll have to tell the entrepreneur, the sole proprietor, or if they have a partnership, they might need a partnership document from the partner. And so this is what creates the time lag. Then once that happens, again, the KYC, KYB will happen, whether it's even digitally or manually. Uske baad jo hai, then comes the credit scoring aspect. And then there will be a credit analyst who will talk to the relationship manager to do surveys of the sole proprietor of the, let's just call it a retail shop, for example, do survey about the inventory, about the environment around it, do some interviews around the community. And all of that qualitative feedback is also taken into the credit score. And then a disbursement is done. And the disbursement, again, because they are digitally set up, that'll happen pretty fast. Yeah. But this is why it takes anywhere between 7 to 21 days. And so when they think about scaling up, it's a linear function for them, right? You have to have more salespeople, you have to have more RMs, etc. And that, with this level of visibility on the risk side, which is a lot of qualitative information, is where they get uncomfortable on the risk to reward aspect.
Okay.
And so I think there's still, that's why I still say that even if hopefully we do, I think that will be a big aspect if we don't get crowded out by the government in this case. One, incentives will align, but again, it's not that once the incentives align, we'll magically see like banks really coming into play, because they're, we'll talk about legacy infrastructure, but I'll talk about legacy operations, right, that they have to kind of contend with. So one thing that we've like really learned is about, and I think like Omer bhai, we've had this conversation a little bit. I think what Haball, for example, are doing really well is just that entire process of digitization of that KYC, KYB, credit scoring, disbursement. It's happening in seconds, sometimes milliseconds, right? Yeah. And that's really also creating that margin for the bank, right? Yeah. And I think that is the really important. Like, and from our point of view, and coming back to credit scoring, at Creditbook, we've kind of like learned a little bit about this. And yes, we do it completely digitally. We're using alternative sources of data, for example, but we're really looking at their transaction data. A lot of these entrepreneurs are on logistics platforms, first party, third party logistics. There's some really, really good transactional data available that allows you to estimate their inventory cycle, their payback cycles, etc. And you can actually build a very, very good set of financial statements to assess the credit worthiness of the entrepreneur. I think, as Omer bhai said, there's part of like willingness to pay back and ability to pay back. Yeah. Right. So I think what we're really trying to credit score and get really right is the ability to pay back. Right. Willingness has to be priced in. Right. We have to take that level, and the price adjusts for it accordingly. But the first principle over here, and for anybody that's going to be in the lending market, the biggest risk to your business, yes, it could be talent, it could be so many things, but it's about getting risk right. If your risk aspect is not right, at some point the chickens come home to roost, right? Yeah. And we've seen that before.
There's a lot of low-hanging fruit data as well that's out there that just people don't look at. I mean, we work now with Foodpanda, the Raast, and a few other platforms, which is just ripe data for me. I ingest it. It's all automated now. We've luckily been able to work with international risk officers that have built like digital banks in other countries, and they've come in and helped us automate an engine where we just ingest that data, and within seconds, you either approved or disapproved on a loan. And that's all based on your transaction history. It's there, and I have direct debit at source, so it's a really clean transaction. And the key is actually then building your credit scoring along the way. So now we have a dynamic engine internally that each company and individual has a credit score attached to them.
And that's something that you guys keep track of?
Yeah, because if we fast forward, it'll take time. I think it'll take another 5 years at least for us to really have a credit scoring engine that's there, that it's essentially Credit Karma in the US, right? Credit Karma essentially displaced the credit bureau because they were able, through looking at transactions and your various lending activities, assign you a score. And then they gamified it as well. And so I think that's where we need to head, make people understand what credit score is. The average person doesn't even know what a credit score is.
I think where the advantage that the three of us have in terms of that learning iteration cycle is unique to what you see in developed market. In developed markets, a lot of mature financial products, for example, you might have something like lending club or lending circle, and a lot of mortgages are happening over there. Those are very, very long feedback loops, right? But you're talking about maybe a Foodpanda merchant is working a 7-day cycle with you, right? And so the ability, similarly for Omer bhai, right, like 15, 14 days, sometimes 30, 45. The ability for us to learn is probably even progressively even
I think
faster.
The good thing that happened to probably all three of us is that we launched financing products in the worst economic circumstances since 1971.
I mean, you guys started when...
But, so we learned it really the hard way because, you're trying to price in 37% inflation where asset quality is horrible. And then you still try to deploy as much as you can. And then you still have to make sure that the NPLs have to stay decent for you to make some money off it. So I think all of that vintage that we've developed is really going to help us with hopefully better times as interest rates start to go down and inflation goes down. That should really feed into the kind of analytics that we're able to produce in predicting our next deployments.
So how do you get the capital to deploy? Like, is it your own money? Like, is this something that investors injected in your company, or do you borrow and then you deploy? Like, how is that?
Don't have to ask Omer. He's really good at that.
I don't know if I'm good at it. But we... thesis for us at the beginning was, so when we raised our first round, we raised $2 million in our seed round. We didn't need that much money for OPEX. We needed about $250,000 to $400,000 for OPEX. The rest was to build our book and track record. Because you can be naive about it and enter a country and be like, this is how it's done elsewhere, and therefore this is how it must be done over here. No one's going to give you money on the back of that, right? You can go to the banks. And not that we didn't try. We went to the banks and said, look, this is what we're trying to do. Would you be interested, et cetera. We went down that route to test it out, knowing full well that most likely it's going to be a no, which it ended up being. But in the background, at least what I'm doing is putting, and like Ali and I diluted ourselves further more than we wanted to in order to put skin in the game and saying, look, we're risking our capital, VC capital, also our kind of sweat equity to be able to prove the thesis out. Give me time. And we said for the first 2 years, for example, we're just not even going to touch formal credit in terms of a source of capital. Build your track record, show what you can do with your own money, and then go to the banks. Which is what we did. We went slightly earlier than the 2 years to the banks. So the first step was speak to the banks. But in parallel, it touches on exactly what you were saying on the Islamic market. So we're Sharia compliant in terms of our, and that's very deliberate in terms of our offering and the way we're building the company. Because if you look at any of these markets, whether it be Malaysia, Indonesia, the Islamic financing market is outpacing conventional day in, day out. And it's much more profitable as well. You look at the NIMs of Islamic banks, for example, much more.
What is NIMs?
Net interest margin.
Okay, fine.
So basically, because you can't pay interest, you've got a very cheap deposit base, and you can lend out at higher because you can structure it to make it, because it has to be Islamic. So you're very profitable. Now, the problem therein lies, exactly to your point, is they don't have places to be able to deploy. So a Mizan bank, for example, can only take in X amount of deposits because they have to offset that through investments into... So when I looked at the market over here, I was like, hold on a second. There is so much capital sitting on the Islamic side that has nowhere to deploy, and it's restricting their growth as well. So for us, we went down a painful route of saying, okay, how do we structure a sukuk?
Okay,
So we went down the route of saying, okay, look, we have good receivables, we have a good portfolio. How do we structure that in a manner that we can then sell that to wholesale? So that was our first route to market in terms of funding the book, was issuing sukuks in the market. And I remember when we first did it, everyone was like, you're an idiot. What are you talking about? You can't do this. You're a fintech, you're a startup. You know where you're going to be able to raise the amount you want to raise. And it was a painful process. We had to get ourselves rated. We got the instrument rated based on the receivables that we get in this covenant section that you have to create. But we were able to pull it through. And now that market is deep. And now that's become a source for us to continuously fund the balance sheet to a certain point. So that was step one. Step two is off balance sheet. So that was an on-balance sheet transaction. Second was off balance sheet. Once we were able to prove ourselves that we were able to create a sukuk, then the banks woke up. And the DFIs woke up and said, hold on a second. We have a mandate for SME, by the way, which we just cannot fill. You've clearly figured something out. You be the source of origination, create a fund vehicle over here where you're the originator. We fund that, and you get a piece of action, no risk on you. Happy days. So that was second source. And lastly is basically what we're doing now is going out to source. Our raw material is cash, and going out to deposit base. So now we're in the final steps of acquiring Finca. And that gives us a massive deposit base to be able to fund our book. So then we go straight to the source, take deposits, and be able to...
So you start as a fintech and you then become a bank.
Look, all roads lead to lending when it comes to fintech. And if you are a lender, our raw material is cash. So the only thing you can do in the cheapest source of cash is a deposit base.
Fair enough,
So for you to have a deposit base, you have to become a bank. So you look at any successful fintech in any market globally, they become a bank.
So the next time we see you, we have to meet you at some club?
That's already the case. It's very hard to get in here. But coming back, okay, the question that I have around that is, in terms of exits, you guys want to be valued at as fintechs, right? And as technology companies, the valuation multiple is very different as opposed to the valuation of a bank. So how do you secure that return on equity for your investors if you go the traditional banking route then?
Cost income ratio.
Oh,
So cost income ratio is a big thing. So that's also a fallacy that's there when it comes to banking multiples versus digital bank multiples and fintech multiples. So I'll give you two very concrete examples. Kaspi, new bank. Kaspi is trading at like 8 times a book. They just listed on the NASDAQ at $25 billion market capitalization. They are a bank. They've got banking licenses. They've got branch network. They've got a fantastic app which now cross-sells, but their cost-income ratio is nothing comparatively to one of the largest banks in the region because your distribution point is no longer physical. So you're able to be far more efficient and enhance your ROEs much higher. So Kaspi has ROEs of like 45%. Banks don't have ROEs of 45%. Nubank, same thing. Very limited physical distribution network, has a distribution network that's physical, but again, cost income ratio very low. Chime versus JP Morgan. Chime has revenue per employee, which is literally 1,000x higher compared to JP Morgan. So the way you differentiate yourselves in terms of multiples is to prove that you are not replicating what an existing banking infrastructure is, and that you are using technology as your source of origination, distribution, risk underwriting, so that you have operating leverage that you do not need to hire. I'll give you one more simple example. There's a company in India called Stashfin. Stashfin has now a loan book size of over $1 billion a year. They only started in 2018, by the way. We've got over $1 billion in loan book. They do 90,000 transactions a day. It's all B2C lending. ROEs are excess of 40%, so they're profitable. They've raised next to no capital from the VC market because these are ex-credit-led fintech entrepreneurs who said, we don't need actually to raise a lot of money for this. All their capital comes off balance sheet. They have a lending license and they get it in. Guess how many employees they have? $1 billion a year.
No idea. Like
84 people.
84. I was going to say a few thousand.
84 people.
Okay.
So they've stayed there. The employee count has not increased from $100 million in deployment to $1 billion.
It's the same 84 people
same
that
84
were deploying
people.
100 million and the
Same 84. Because the moment your systems are in place and you have that data coming in, you no longer need human infrastructure. So that's the big aspect that you have to be able to prove. If you can prove you have operating leverage in your business, which means basically you're able to grow your top line and bottom line without actually touching your SG&A, happy days.
And you feel Pakistan has the infrastructure, the talent and all for you to be able to do it?
You just need the whole point is that you don't need a lot of talent.
Just less talent, yeah, okay, fine.
You need less talent, you need the infrastructure to build out in terms of your tech stack that's able to
But
pull
what
enough.
about the infrastructure that's not in your control? So say India has UPI, etc. You still need that, right?
I don't think that is a struggle here. It's really about whether it's a fintech or it's a bank trying to digitize MSME lending. It's exactly what he said, that they don't have the patience to go through the different evolutionary cycles of that infrastructure. So there is that central bank infrastructure, whether it's Raast or RTGS or OneLink or NIFT, and then you have these distribution channels such as fintechs who can leverage those rails, whether it's Abhi or Creditbook or Haball or Kinu. It's really about us as fintechs having the patience to let it play out. Because see, we learn credit through credit cycles. We can't say, oh, I've done it for 3 months and now I know what it is. You're lying to yourself. You have to go through 3 or 4 years cycle. You have to go through a depression, which we are going through, and then you have to go through a boom as well, where the interest rates are low, and then you're able to deploy, and be able to then say that yes, I figured it out, and the algo is self-healing and it fixes itself, and that infrastructure I think none of us have reached that maturity where we can really say that, I've seen 3 or 4 cycles now. Now I understand what it is, and let it just scale, let the volumes come to you as opposed to you go to the volumes. Because what everyone was trying to do was trying to grab business, trying to grab market share, no matter what tools that they had, whether they were deploying VC equity into it or they were deploying other tricks of the trade. But you really have to wait it out, especially for a country as erratic as Pakistan, where there's a lot of asymmetry in terms of information. You've had 4 governments changed in the last 2 years. And that obviously creates a lot of slack with the regulator, because you're trying to bring these innovations while you're looking at the regulator, please let me do it. To your point where a representative has to go and visit the MSME, that's PR, that's prudential regulations. There is a one visit rule over there.
Yeah.
You can't do anything about it. So with the regulator, and the regulator is progressive enough to let you sort of give you some exceptions or mold the regulation if they see that there's a lot of scale coming in. But you also have to appreciate that these are people who are living in the same country with the same environment. They're also confused about direction. What does the Ministry of Finance want? Who is the Minister of Finance?
Yeah.
Who's in control? So all of those are fundamental questions that eventually trickle down into the pace of innovation or the maturity of the infrastructure that you're trying to create for your respective organizations. And which is why, when you look at other countries, you see that, it scales really quickly, that companies have been around for 3 or 4 years and been able to deploy, let's say, $1 billion, and you don't see those stories in Pakistan. It's because, at least between the 3 of us, we were deploying it in the worst economy.
Yeah.
Right? So you had to be cautious about what you were doing, and you had to look at the pace of the country where at 37% inflation, with a lot of price volatility. I'll give you an example. There was a customer that said, we'll give you 100% guarantee, 100% loss cover, and it was a transaction for poultry feed, sort of dealers and distributors to be financed. Couldn't do it because there's a lot of price volatility in that, because the exchange rate had shot up from 180 to 300, and then so all of that whole drama that happened, and couldn't really finance a transaction where there was so much price volatility, where you knew that some businesses would get shut. So that kind of environment means that if you look at the economy, the large scale manufacturing, almost 60% of the sector is in negative growth right now. And if those manufacturers on a P&L level are posting losses or in a decline, imagine what's happening downstream. And yes, of course they need liquidity, but that's a lot of risk as well, right? So there wasn't enough to sort of play with. So that's what I'm trying to say, is that in Pakistan, the maturity of infrastructure, whether you can build tech around it or build these analytics and algos and optimize your disbursements and your collections and your default sort of monitoring, credit governance, but still there is an aging that is required for that infrastructure to mature in a country with the kind of asymmetry that we have. And I've always struggled with that, because I've always felt that the information within these verticals has to be really sort of, you have to do a lot of rummaging, look at it from multiple angles before you can even start deploying in a particular supply chain, as opposed to just start throwing it and see what happens. So yeah, that's I think one thing. But in other countries where they understand that the macros are fundamentally in control, and you can clearly draw that relationship downstream into their supply chains, I think for them it's perhaps easier to start deploying a lot quicker than what we've been able to experience in Pakistan.
I think also when I'm good, because I don't know the company StashFin, for example, you mentioned, but it also kind of boils down to the details, right? So if I'm doing X thousand amount of transactions a day, but I have it as a revolver facility, which means that as soon as you pay, you get the money back again. I actually don't know how good have I actually been in terms of my risk decision. At some point, the only time you'll really learn is if you have that cooling off period to actually test your credit decision. By the cooling off period means that Mubariz pays Hasib back.
Yeah.
Mubariz needs credit, but Hasib says for 7 days, I'm sitting on this. Can your business withstand and normal operations without that extra liquidity? And sometimes this is what happens in lending businesses, is that the scary thing is that, for example, when we look at our books, we have to look at both cash receivables, and then we have to also look at the accrual aspect. And on the accrual aspect, you can really get intoxicated because you are just thinking about disbursements, and then you're thinking about future collections. Yes, with a probability of default, but one can get really, really intoxicated to just disburse, post revenue when it hasn't actually been received. And that's how we've seen a lot of like businesses in the past like 10 years, right, that have gone through just big macroeconomic cycles. Let's call it from 2006 to 2024. There have been like 3 global macro cycles. And each time you've had like these fintechs, or like at that time fintech didn't exist, but like these financial services companies that did massive deployments, and even talked about their NPLs being very, very low, and then suddenly one day they just go bust, and you're like, hey, what happened over here? And the thing is, in operating a credit business, is that the devil is in the details. And I'm just talking about this revolver as a very small example, but I think to Omer bhai's point of view, and like why I really come back to him, is that I've actually learned a lot by just seeing how he operates, right? Yeah. And I kid you not, like when the 2020-2021 funding cycle was happening, I think he was one of the only entrepreneurs that was still playing it very, very conservative. Still, I mean, conservative to the market. Yeah. That's what I mean to say. And I asked myself, like, why is that? And of course, like when we were building Creditbook, we did some experiments, and I started to realize, I was like, oh, when you give money, and if you have the revolver facility over there, and you don't, the moment we created a cooling off period, we started to see that, okay, the repayments weren't coming in as fast. And thankfully, we learned some of these hard lessons early on. But the devil is really in the details in a lending business. You can really intoxicate yourself with a lot of growth, with a lot of impact. But if you don't have your finger on the pulse, at some point it can just come explode. And then everyone's like, hey, what happened over here?
So if all 3 companies, for example, exist, and you were to enter this space as a fresh entrepreneur, where are the opportunities? Like Abhi exists, Haball exists, Creditbook exists, and Omair is now starting a new company. In this space in Pakistan, where would you say are the opportunities?
Same space.
Same space, same thing?
Same exact
same thing?
Literally.
We're barely scratching the surface.
Yeah.
Okay.
I've done nothing. What have I done so far?
No, but like, is there some other segment that you feel like is not served through Abhi or through any of the existing companies?
Yeah, of course. I mean, agri is, of course, we're completely ignoring it. Service industry is education. I mean, I think
education they've started like this. Yeah, Adilfai and Uran are both doing.
And all of these guys are probably doing something.
Adilfai something else.
But education, healthcare, agri, lots of sectors that we're just ignoring right now. I mean, even just within the supply chain financing segment that we serve, there's a lot that we're not doing right now. There are some good agri value chains as well. Some of these input providers are really good. Then there is...
but why can't you service them right now?
Then there is... I mean, we're trying to do it now, but initially, we were 2021, the floods and all of that. So obviously there's a risk over there. And now that we've had bumper crops, and you have to look at some of the cycle, because usually after floods there's always a better yield, and some of these agri producers have performed really, really well. So we're now actively looking at some of those segments. But again, we did end up ignoring some of these things because we thought we're just focused on FMCG, where the margins are fixed, the demand is never going to go away. It's always going to grow at, usually it grows at like 10%, but even in the worst economy, it grew at like 3%.
Okay.
Still grew.
Yeah.
So we kept focusing on that segment where it's consumer needs. So many sectors I think that we've just simply ignored. But I mean, for Haball, we just don't do anything that's related to consumer. So that's a deliberate sort of strategy, you could say, that we're not doing anywhere, and any lending where it's a consumer who's the recipient of it.
Why is that? Like, so consumer lending, just to simplify, would be lending it to individuals who are spending that money for their own personal needs, as opposed to someone doing it for business, right?
Yeah.
But why is that decision? Like, I know Abhi does both, right? Abhi would do salary financing and the SME thing, but why have you just chosen the?
Well, there are multiple reasons for it. I mean, initially we thought the raw reasoning at the beginning of Haball was, and this applies to payments as well, because we don't do consumer payments as well. We thought that the banks are sufficiently addressing this problem, and there are too many fintechs in this space. So why pick an area where everyone is there? And to his point, when he said that in 2021 you guys didn't deploy anywhere, we thought, there are like at least 5 or 6 B2B e-commerce players over here who are going to address the problem of retailer digitization. You had Creditbook, you had DG Khata, you had Bazaar and Retailo and Jugnu and Tajir and Dastagir and all of these guys addressing the retailer. I said, why even try to serve this? There's like millions of dollars raised to spoil the retailer right now. And my strategy is not to spoil them. I'm not going to give them discounts, because we just have to see if there's a price margin and we can blend in our services within that margin. Otherwise, there's no sales over there. If you can't pay us, then we're not going to sell you anything. So that was a deliberate move, that retailer segment at that time, and also consumer, there were too many players there. And then we just sort of, became comfortable in our segment.
Makes sense.
I mean, I'm giving you a lazy answer, but we became comfortable in the MSME segment that just focus on some of these supply chains over here. And then we sort of started calling it a strategy that we've consolidated around manufacturer distributor, and then making sure that now we can be used across 7 verticals. So now we have 7 different supply chains where the product works, both payments and financing. So there's so much space over here to exactly what he said, that, why look anywhere else where there's, at this point in time and these macro conditions, there's a lot of risk. And for consumer financing, I mean, I personally felt that the product structuring in terms of your ability to assess them, it's something that is not in our DNA. You have to also classify what your DNA is as a company. We're able to recognize institutions because we know what are some of the metrics, government data or trade data that you can look at to say that, oh, this is a company that does 500 million rupees in turnover and this is their margin. But in terms of an individual, I think that's a capability we simply don't have, or we didn't even try developing it. And now it's just the supply chain B2B segment that we're comfortable in. And there's so much space over here that, quite frankly, there's nothing else to look at this point in time.
So before we go into the startup questions, like your journey as a startup founder and an entrepreneur in Pakistan, last question around just the infrastructure around payments is Raast. What do you guys think about Raast?
Work in progress.
It's a work in progress?
Yeah, it's a work in progress. I think the big difference, and you touched on infrastructure before, I actually think the infrastructure with OneLink, for example, is sufficient for us at the moment. There's so much more that you can leverage just on the back of that, which India didn't have, by the way, before UPI, and that's a big difference. They
did not have anything that's.
They had a simple IBFT between like the banks and stuff, but they didn't have. That's why Paytm was created, right? Paytm was that, and Paytm's MDR, etc., went to almost zero because of UPI, right? So yeah, look, I think the infrastructure aspect is fine over here, and Raast obviously makes it a little bit more seamless. It's got the P2P aspect, etc., as well. But it's an execution thing, which will take time, I think. Again, because this is a government-led aspect. You look at Brazil with Pix, you look at India with UPI. These are, again, government-led initiatives. And unless the government's willing to go and really push it, it'll stay dormant.
I think, again, Omer bhai, maybe you can kind of comment as well a bit more. But my just take is that if you're thinking about Raast as the technology and then the implementation, technologically it's pretty good, right? Like how it's been architected and proposed, etc. The implementation, it being a government-led initiative, also needs support from different other functions. in order to have like a take up. So like, for a startup, we might talk about a go-to-market strategy. The go-to-market strategy for Raast is that the technology is excellent, the adoption will come. And it's not, and that feels a bit half-baked a little bit, right? And it needs the support of the FPR over there, and it needs the political will of a government to be able to support the FPR to help Raast on the P2M side, the peer-to-merchant side. There are other low-hanging fruits about, when you are doing, for example, stimulus disbursements, so the BISP program, etc., that has to continue. That digitization of, in India, what did you have? You had the complement of the stimulus packages and then like 0 rupee bank accounts, right? Connected to the Aadhaar system. And, Nadra came and our own biometric came before Aadhaar, right? But we still haven't done the 0 rupee bank account. So just complementing these things with the technology is how the take up, in my opinion, needs to happen. But I don't know if you can comment a little bit.
Yeah, I think State Bank has done a fantastic job in terms of infrastructure.
Yeah.
There is in 2017. I'll share this white paper. You can. It's a public document. We wrote that you can't accelerate corporate payments without contextualizing them. And one of the problems with the current infrastructure with OneLink was that it was written on ISO 8538 format, which meant that any non-payment data could not travel with the rail, which was very important. How did I learn this? Because when we were trying to digitize FPR payment collections, so when you pay your, let's say, customs taxes, it has 3 or 4 tax heads. It has the income tax, sales tax, customs duties, FED, sometimes it's a regulatory duty, sometimes there's anti-dumping. And so when you're paying 2 million rupees, it has to be broken into those 5 or 6 heads, and everyone has a different sort of constitutional allocation that sales tax will go to the provinces and income tax will go to the federation. So when we threw the money into the central bank, we had to tell the central bank that this 2,500,000 is sales tax. It goes in a different bank account at the federal consolidated funds. FED has to go in a different fund. Income tax will go differently. RD will go into this Ministry of Commerce organization that collects anti-dumping duties. And we just realized we couldn't do it. So we had to come up with like weird mnemonics to codify what that 2 million was broken into in terms of sales tax and all of that. And at that point, we realized that there's a problem over here. That when you're transmitting financial data, when you do a P2P transfer or an IBFT, you can't send anything else. So one of the good things that has happened, which you guys will probably untap when you start using Raast as a rail for financing as well. And there's a fantastic play on that as well, where the ISO 2022 format, you can send images in it. You can send a lot of contextual data, non-payment data between 2 institutions. So that ability to move contextual data has amazing sort of use cases that can spring out of it. Now that's one of the silent things that probably is not talked about. But we're very excited about it. The other thing is, of course, you all understand that Pakistan struggled with, for the longest period, especially on the retailer, consumer to merchant payments, settlements in some of the days would happen like after 14 days, and then it came to 7 days and 3 days. But largely the market sat at T+1 or T+3. So Raast is instant settlement, and that obviously liquidity is everything. You want it today, you don't want it tomorrow, you don't want it on the 5:30 RTGS batch, you don't want it in the future. Right then. And the third thing is, of course, when it's a public good, it's a public utility. The price, of course, has a very big, where we felt that over the years, OneLink, fantastic management. I think in the last 6 years, Najib has done a fantastic job in giving the organization a facelift and being more open and enabling whatever we're doing is because of some of the changes that Najib and his team has brought in. But I think the architectural problem still remains that it is a bank-led, bank-owned system. And that is in some time, in most cases, very paralyzing for the industry because you're pricing in protective covenants for the banks. And that just sort of is unfair to a lot of fintechs. So, of course, Najib has tried to dilute that impact as much as he can. I don't know if I'm supposed to say this publicly, but yeah, he is. But yeah, I think they've done a good job, and I think central bank has stepped in to make sure that OneLink becomes a market maker, which is good. And they've been doing it very sort of responsibly and still keeping it as a level playing field and keeping it fair. We're hoping that some of these fundamental problems in terms of ownership and how these capabilities can be distributed across the fintech ecosystem will be done by the Raast team, that they will be able to provide that access. So Raast has multiple phases. The first phase was just, using banks as a P2P or a bulk transfer rail. I think the next phase is very exciting, the P2M phase or the PISP phase, where, Creditbook will benefit from it, and Abhi will benefit, and Haball will benefit from it.
Because merchants will be able to receive.
That's when
and the QR code on the merchant thing
plays out. Yeah, that's when it plays out. So, and then you can't really keep on looking at State Bank and say that, oh, you haven't done it, because then now it's you. We've given you the rails. Please go and distribute whichever way you want to distribute, however you want to price
The one
it.
thing that I think is required still is, I think there's, I'm not sure if you can comment on it or not, but it's the AISP side of things, right? So that any fintech or any player can actually use the Raast rail without having to go to
through a bank.
That's
the biggest problem right now. Is
and
direct
so
integration.
like unless you are a, let's call it a state bank regulated entity, an EMI, PSP, PSO, you can't actually access or there is no clarity on whether you will be able to access the rails directly or whether you will have to always go through. And I think
that's being changed, I believe, but implementation.
Yeah, I think this particular problem of direct access without being regulated is not just a Pakistani problem. It's regulators are facing this challenge all across the globe, and there are good reasons for it.
Yeah.
So let's say Abhi has payments processing of more than, let's say, 200 billion rupees. Now that's a lot of risk on Abhi, and let's say if Omer tomorrow decides that I don't want to do it. So central bank has to have some sort of way to control, owner risk or equity risk or liquidity risk or cyber threats and all of those things. Those are some real problems. But they don't want to burden you with regulation. They have to make it sort of featherweight. And that's the balance that all regulators are trying to find. It's not just Pakistan. It's everyone's trying to find that right balance where you don't over-regulate by something as onerous as a bank or a microfinance bank or a digital retail bank or even in some cases a PSP or an EMI. What's that right mix where you can give a Food Panda or a Kareem access to Raast without actually turning them into regulated entities, because Food Panda doesn't want to be a regulated entity. So they'll probably figure it out. They'll do some piloting, see what the risks are, and then come up with the right mix for Pakistan. And probably in a year or two that'll become very apparent. But the fact that the rails exist now is a very positive sign. It just means that now all of us as fintechs have to figure out how do we create that right risk profile where they can give us access and still be able to distribute and scale these services.
एक और जो हमारा इस पूरी एपिसोड का ऑब्जेक्टिव है वो ये है कि एंटरप्रेन्योर्स के लिए एक्शनेबल एडवाइस, राइट? जो वो भले वो फिनटेक में हो या ना हो, बट वो किस स्पेस में और जिस भी स्पेस में हो उनके लिए हम एडवाइस वो लेके रहिए. सो स्टार्टिंग विथ when you have an idea and you know that you actually need a lot of investment, उस investment के through आप उस idea को implement कर सकते हैं. How do you go about how do you do the cold start? किस तरह से start होता है? किस तरह से आप उसमें आगे लेके चलते हैं? Like one thing that I've personally struggled with is MVP, because I feel like या तो सब चीजें सही हो या नहीं हो. Like with this podcast, like I was telling you guys, like my friend Muru, who's a YouTuber, after watching 50 videos, I was like, नहीं मुझे set भी चाहिए, मुझे ये भी चाहिए. उसने कहा यार चुप करके बस start करो, right? And I'll give you the basics and just start off, and that's how you will learn more. And after recording a couple of episodes, I'm realizing, there was a lot to learn and to figure out. So how did this journey start for you? Like more specifically, and what advice would you give to founders about MVPs? कि basic जो minimum viable product है किस तरह बनाना चाहिए?
Yeah, I think my journey was slightly different because I had built the payment system for FPR, which is very similar to the kind of logic that is applied on Haball's payment system. So I wasn't really learning on the job. I had done it on someone else's expenses and then tried to build it again. The only difference was that's a government mandate where you had to use it. In a way, you had to sell the value of it. So I think our learning was really about, okay, fine, we built this product, it works, but we have to sell it to some of the largest corporations in the country. So you have to sell them the value. And so MVP was really just getting it done very quickly, but being able to sell it and then to tweak it according to every supply chain. But that's where the real sort of agility and the learning happened.
How did you get your initial capital to do the MVP?
So that was just friends and family. Gathered enough to sort of fund ourselves for the first 2 years. Then we got an investment around 2021 through a private sort of conglomerate, associates. And I want to credit them for one thing is that because when they entered, one of the things was clear that the product works and we had some transactions. And we had the state bank sort of funding available as well, and that gave us another sort of runway. But the good thing that came out of this investment was that they were very focused on, just going and launching it, especially around the distributor space. Hasib talked about it, that 2021, everyone's raising, and we had just concluded this. So all we had to do now was, we had the product, it got the central bank blessings, all the banks were ready on it. We just had to go and start selling it aggressively. And this is post-COVID, so the world's very different. So that's what we did. We just kept selling it, and every new customer gave us more intellectual capital because in a B2B sale, there's a longer delivery period. It's not plug and play.
Yeah.
You have to have a 1 to 1.5 month gap analysis, customizations, UAT, systems integration testing, then you go live. Within that 1.5 month, you're building like rich features for customers who are actually telling you what they need. And that's where the MVP turned into a commercially ready product. So yeah, we were lucky in that sense that the customers fed into what actually worked for each supply chain.
Omer, how was Abhi's journey?
So I'd say no business needs a lot of money to start for you to test out whether you're building a good business or not. So scratch that from your mind. If you think that the only way for you to build a successful business is that your starting point has to be a lot of capital, and whatever you consider a lot of capital, scrap it. You're a entrepreneur. I know you put that as a positive. I think that's a negative, because you don't know that people actually want your product. So what we did, for example, at the beginning, I was actually still in New York. Ali was in Karachi. We spent a grand total of maybe 2,000 rupees. We printed out a poster which said, this was when we were only doing the EWA aspect. That she said, do you want your salary in advance? How much do you want? WhatsApp this number if you want your salary in advance. And that's it. It was in Urdu as well. Ali wrote it out.
So there was just a WhatsApp number?
There's a WhatsApp number.
Okay.
And we put it around this office of one of the earliest customers that we were able to bring on to test it out. Said we were always B2B2C, so we knew we were going to conduct it from HR. So we just really speak to HR, get them on our side saying that please at the end of the month, we'll send you a bill saying this is how many people have taken out the money, and you pay us back and you pay them the remainder. That's all we spent. We spend that, we put it around the office and let the market tell us whether they want it or not. So then what happened is literally within 2 to 3 weeks, about 20, 25%, up to 30% of the employee base started transacting. So Ali was still working at that time. I was still working in New York. We used to have bets with each other how many transactions would happen during that day. And then he'd get the WhatsApp message. And then he'd go home at the end of the day after he finished work. And then he'd EFT it from his bank account.
So personal. So you guys were using your personal money?
Personal money.
Yeah.
So we put a little bit of money. Do people actually want the product? Then when we saw people wanted the product without us having to spend a lot of money on marketing, it's just a natural inclination that then they were able to figure out the closed loop of how to, then we said, okay, now let's go out and validate, now let's go out and raise capital for us to scale it. Because at that point, then you're saying, okay, I'm dreaming big. I know this requires money for me to scale the business. But my advice is do it with next to no money at first. for you to test whether people actually want your product. You can go into this kind of intellectual debate and build a massive company in your head and in a room.
Yeah.
Very easily. Very easily. And then you're going to say, oh, but then I have to spend this and this. And it's like, no.
Yeah.
Just go and find your first customer.
So how much has what has changed in terms of what your initial assumptions were from your early MVP feedback?
Sure.
Say it was only for, say, salary financing.
Yeah.
What has been the difference?
Early stages, when you start, the first set of customers were friendlies, right? People who own businesses that are your friends, family, etc. Your sales cycle is shorter, integration is also easier, etc. Because you just have a friend. The moment you go to the real market, that's when you're really testing the real pushback to your product. And that was, it wasn't easy. It's part of the reason why we ended up going into the B2B financing, because at the end of the day, a lot of companies just didn't care about the employee base as much as the product was helping the employee base, and we did this whole B2B2C, and it helps with the morale of people and this, that,
Didn't care.
Didn't care. So the B2B enterprise sales cycle, as well as the convincing that's required to bring something like this, was not easy. So I think elements of that, of how we had to hone the sales process, the go-to-market, was something that we had to fix along the way.
I think when I talk to some people, and our story is yet to be told, right? So not coming off over here like we're some experts, and I don't think that's the intention. It's just about how to start a business. I think what I see when I hear entrepreneurs that are itching to get something started is a reluctance to sometimes understand the core aspect, which is that you have to do everything. Like, there's no substitute for that hard work. So, you guys printed flyers, you guys were doing the sales. You have to do everything. You have to do product design. You have to even do engineering if you have to do it, right? And then you figure out all the other steps that kind of come after that. But you have to be in the detail of every single thing in those initial days. And there's literally no substitute for that. You have to be doing all of the customer testing. You have to be doing all of the pitching. You have to be doing all the developing. And it's a really, really key start to bootstrap your business, because you understand those fundamentals. You don't ever lose those, right? There'll be economic peaks and troughs, but you'll always go back to that, because it actually builds a lot of strength. For Creditbook as well, when we started, we literally just put our own money, which was just literally, I'm just talking about it, rupees, like 30,000 rupees to just get started, which was like, okay, we're going to test out some Google channels and marketing and this, that, and then we were going into the market. For us, it was interesting because COVID had hit and lockdowns had hit, and we saw it as an opportunity, which was like, no one is probably doing door-to-door sales to retailers. Let's go out and do it.
Yeah.
Right? And we did product development like that. And we went in with wireframes, Iman and I, we were like sketching things out, and we were understanding how the product needs to be built. We were looking at their khatas at that time, seeing how they were like doing entries, doing some of them on their behalf, a lot of manual work to understand like how to develop the product, right? And then like, okay, I realized, okay, fine, after doing stuff on Figma and Sketch, and you do prototyping, and you finally believe that, okay, you have something that actually has a flow, you need an engineer. We decided, okay, fine, let's get some grant money. We didn't have that money, like that personal money available. So then we went to Standard Chartered. We did this, I was telling you guys about it, this, female program. We got $10,000 in that. It was tranche based, but it got us that validation. It allowed us to then scale a bit on marketing. But it came back to those fundamentals of, you have to be on the ground. You have to do everything. There's no kind of substitute for it. So when you're starting a business, just as Omer said, like, you can start thinking big really, really fast and think about all the things that have to happen to meet that vision. But to just take that first step about like actually validating, it's on you. It's just on pure skill set. You might not know a skill set. You can, I was YouTubing Figma and stuff like that. And that's what you just have to kind of do.
So in terms of like your conversations with early investors, like how much capital has Creditbook raised?
We've raised now a total of
$12.5 million, right? So in terms of how quickly did you raise this money in?
First 2 years, not quickly at all. and then for the following 6 months, very quickly.
Okay, fine. And what year was
so like
this?
when we started the business was end of 2019.
Okay.
And we didn't raise until June of 2021.
Okay.
The seed round, and then we got another extension on that in December of the same year. So then very, very quickly.
Okay. And how much did those conversations with investors were informed by your MVP journey?
Like especially the seed round, right? We took a bit of grant money, we tested out our marketing channels, we tested out the product's retention, we improved the product. But it was very, very, like every time we would go to one stage, an investor would ask us, okay, I'm seeing the data right now, I'm seeing this curve, but I don't know if there's going to be a trough at the end of it.
Yeah.
And at that point, we went to an angel. One angel gave us $5,000, another angel gave us $7,000. We went to our family, and we just kept on showing that curve actually existed. And then the retention actually improved of the product because we got to invest in the product. And that's how then the seed round kind of came in.
So what about you, Omer? In terms of Abhi's journey, how much capital have you guys raised?
About $24 million.
$24 million. And
In equity funding.
In equity funding. And then debt, and of course, the sukuk and all are separate. So if you were to like give a breakdown on, because you've clearly raised more money than everyone else on this table, if you were to give a breakdown on fundraising to, say, entrepreneurs in Pakistan right now, what would you say? Like in terms of how should you find the right investors? To what kind of pitch do they care about? Like what is it that they're looking for?
I'll disagree with the question.
Okay.
I don't think it's not about what the investor is looking for a pitch. What are you trying to build? I never went out to an investor trying to figure out what they're looking for. That wasn't the way. I was building a company. Ali and I had a thesis in terms of what we wanted to build. We saw what the problem statement was. We saw that what we did in our MVP proved the thesis. Do you like this or not? So that's one aspect of it. I did not go and try and suss out the other side. I know there's some people who do that. They'll do lengthy research into the investor. We don't do that. What we did, the only thing which was a checkbox or criteria for us early days and still remains, are fintech VCs.
Yeah, okay,
because that was important, because fintech is very different from a generalist. And I think the ones who go after generalists and building, those are the ones who tend to not support you during the times when you need them because they just don't understand the business. So fintech was something, knowledge was something which was very important for us. And so we targeted from that perspective. But we never did the whole, what are they looking for? It's tell your story, look what and then align, the other thing I'd say is on the other side is align what they are looking for in their investment thesis.
Yeah.
And what I mean by that is we said no to a lot of capital, even during the bull market that happened in Pakistan, because there were those investors that I knew had never touched Pakistan before, never touched emerging markets before, had a thesis of blitz scaling, which works for some. Ali and I are just not those kind of entrepreneurs that believe in that kind of model. We believed in profitability early. We were profitable within 6 months of launch, for example, and continue to be profitable. There's certain investors who we knew we had one investor, for example, they reached out to us. We had a call with them for like 30 minutes. 10 minutes later, we had a term sheet in our inbox for a stupid valuation and a good investment amount. But the KPIs were you have to burn X amount a month. I'm like, why would I burn money for the sake of burning money? Oh, no, this is how you need to do it, and you burn, this is how you build your user base, and then don't worry, when you burn that money, we'll be there on the other side to give you more money.
But they're not there anymore.
They're not there. So that's something you need to be very careful of, is make sure you're aligned from I think, principle perspective of how you're trying to build your business.
But in terms of the people you reach out to, right? How do you filter that? That's what I'm saying. Like that's what I'm trying to gauge, right? So if say someone wants to start like now finding capital, they have validated their product. What would you say is the sequence of events? Like what is it that they do first? Like how do you find the VCs that align with you?
I mean, the various sources now, especially now, it's become much easier. When we launched, it wasn't as easy, but now. You can literally see which funds focus on which verticals, who does emerging markets, Look at track record. Look at companies. So I think the easiest way actually to do it is look at you as an entrepreneur or starting a new company should always have a North Star.
Yeah.
What I mean by North Star, it's either an individual who typically has started a business before, or it's already an existing business that's doing well in another country, for example. Just take a look at them, look at their cap table.
And who all invested in them, especially
Who's
the
invested in
early
them, who's
investors?
come in early over there, and that's the starting point. Because if they back them, and you're building a similar thesis, the likelihood of them wanting to back you is also there.
So, Omer, but in your journey, it started much earlier, right? Before a lot of VC money came into Pakistan. I remember we met when you were starting Haball.
Where you educated us what VC was.
Yeah, exactly. We did not have any VC. Like, I think the biggest deals at that point were like $30,000 for like 40% of your company, stuff like that, right? But at that time, you still managed to raise a decent amount. And I know the valuation and all has changed over time. But how did you view VC? Like, you're operating a business, everything's going, and now suddenly so much money is coming in.
Yeah, I think up till 2022, we pretty much just ignored what was going on, or we were just trying to understand what was going on. Especially, when we started interacting, that okay, so these are the new rules of the game. This is how capital is raised. That's what you need if you need it. And before that, it was all about getting the right infrastructure done and making sure that you're selling it at the right price and that you're able to make a deal out of every sale that you do. So that's what we were focused on. What happened in 2022 or something like that, that's when the VC market, I think, was about to die. Ukraine happened and all of that. And at that point in time, we felt that we needed that extra sort of boost to do the next thing, especially around supply chain financing. So that's when we actually made our first step towards venture capital and started talking. And then, since then, it's been a sort of I think it's been a good journey for us, given that we've always had good options to raise from, even though that Pakistan was not doing well. But the core issue has always been that in these macros, do you really want to raise? Because you're obviously subjecting yourself to certain stencils where global VCs or regional VCs have placed Pakistan in a box and they're not able to see your value beyond that. So you just had to choose, what kind of capital you're going to attract. And at that point in time, we realized that, we're just going to raise what you actually really fundamentally need, which isn't, we've never attracted the kind of capital that boosts sales. That doesn't work in B2B.
Yeah.
B2B, you can't throw money at the problem.
Yeah.
It has to be value driven. It has a certain age. It has a certain cycle. You can't sort of skip the line. And so capital is a function of what else do you want to build in terms of infrastructure and when do you want to build it, as opposed to let's just have a lot of money on our banks.
I think just on that, I think one takeaway right now is definitely the macros. I think if someone's listening to this, they're thinking, okay, the three people who've raised VC money, how do I kind of do it? And I think Omer Bhai's point is completely correct. One is make a decision, do you want to raise in these macros or not? But if you are starting out, people will think, okay, let's just say I've validated my MVP. How do I get that $100,000, $200,000 investment? If your capital requires it to, hit certain milestones, again, not to just fatten up the balance sheet, but just thinking about milestones. Look, I know as well, before we started Creditbook, what we were doing was we were working as consultants. We were just earning money and we were doing a day job and we were just taking that and then thinking about and then we put that money into the company, so to speak, right? I know there's another entrepreneur right now that I'm just been following his journey for the last 5 years. He's gonna build a product company, but it's taken him 3 years of just services work to just save up. And that is another course, but he has a very strong vision of what he needs to do, how he needs to do it. So yeah, they're definitely easier macros to raise in, and we were a benefit to that. And in hindsight, it was good that we fattened up our balance sheets to kind of not only just ride out the wave, but to be able to be here for the long term. But then there are also troughs, and then you have to have alternate sources. You have to do a little bit of consulting work and build your business that way.
That makes sense. How'd you guys, you don't have a co-founder as such, yeah, but how'd you guys find your co-founders?
Mine's my wife, one of them.
One of them.
That's the same. So let's say be careful.
That's fairly convenient.
So you just wake up and be like, hey, shall we?
Company, let's just do it.
Yeah, I mean, Iman and I had been thinking about starting a company for a while, which is when we were doing those kind of consulting gigs and stuff. So the intention was there early on, a lot of vision alignment about how to build a product, how to build a company. Hish, actually, who's my third co-founder, Hisham. He's my best friend's brother-in-law.
Okay.
And so when we were kind of going into the lending vertical, or we were thinking about how to digitize merchants, small merchants, Hish was doing that because he was working for his father's company who were doing auto parts and PVC distribution. So he was kind of already working on that problem, and we just kind of like got introduced by my best friend, and like I think over 3-4 months of just meeting each other and talking, we ended up then forming the company.
I think to be fair to our wives, they've been sort of co-founders as well.
It's true.
Is this on record? Like, do they get equity straight?
Of course they do. They have it all. Yeah.
But what about you, Omer? Like, how did you and Ali meet and decide to do this?
So ours was when I decided to go down this route. I had two big weaknesses I had to understand, which were my weaknesses. One, I'd never lived in Pakistan before.
Yeah.
And I'd never been operational before. My background was investing. I say this to every investment banker, and at that time as well, you know nothing about operating a company just because you've invested in a company.
Yeah.
You may look like a hero, etc., because you've invested in successful companies, but you know nothing about operating a company. And I knew that. I understood that. I just knew what I saw from the outside, but I didn't have the operational experience. And then the most important part was Pakistan experience. I think coming in as a foreigner, which is actually maybe ethnicity, I'm from here, but you can tell by my accent, I'm not exactly from here. I'd be taken for a ride. It would not be successful. It'd be stupid for me to try and do that. So that was one. And the second was technology also. I mean, I know you say you should roll up your sleeves and code. I've tried, I'm terrible. And so we needed someone to come on board to do the technology. So the first part was the COO part of it. And so when I started coming back and forth a lot more, I started literally asking friends who were here already, family who was here already, saying, I'm looking for a co-founder who has entrepreneurial experience, comes from that kind of background, works in fintech, like ideally. And I started meeting people. And luckily, Ali and I got introduced through a common friend who I really trusted. And then we just kind of hit it off and he was at the tail end of his journey at Fori. I kind of said, look, I have this idea of being able to do something over here. And we said, let's test it out. And the rest is history. So it was a little bit more orchestrated, but yeah.
But in terms of like the framework of choosing a co-founder, like the complementary skill set, right? That's very crucial. In terms of hiring the first few people, like your first 10 employees, etc., which is very important, what part of the core functions would you say the founders should never delegate, or like should entirely be under the founder's control? Is there anything in specific? Everything?
Don't delegate anything.
Don't delegate anything. Everything, like you have to in the beginning.
Still say that now?
No, not now.
Not
now. Early stages.
Early stages.
Early stages, you don't delegate at all.
Yeah.
Okay.
Otherwise, it's impossible to run it. Yeah.
Yeah.
I think initially what I've found very hard to still get rid of is I still want to be in front of the customer and sell it. And my team hates me for it. Like, you don't get involved in sales. Because one of the things that you end up doing as a founder is you will make the sale. and your team they know the framework, and they'll stay within the framework. They'll take more time, but they'll stay within the framework. Whereas you're like, let's wrap it up, let's shake hands and leave, because you can take that decision. So I like selling. I really like it. And I've now in the last 2 years, we have a good sort of enterprise sales team, led by someone who can manage that funnel. And for us in B2B, it's all about funnel management. It's just a funnel, and you have to make sure it crosses every stage and it keeps moving. So I still miss it, and I still end up involving myself, especially on some strategic sort of accounts or big accounts. Other than that, on the product side, very early on, very fortunate to have Saqib on the team, and Saqib was product and engineering. All of that comes under him, and has maintained those relationships with the banks or with on the corporate side and structuring the product. But I do get involved on a sort of weekly sprint prioritization or some fundamental architectural issues. I used to get involved more in the beginning, less now, because it's very sorted under.
Yeah.
He has an army under him that does different functions. So yeah, I think sales is still something that, but now, particularly in the last 2 years, I find myself involved less in sales and less in product development, but more on social capital and regulatory relationships. I think that just consumes me right now. I spend a lot of time just doing that. Because as you scale, you have more compliances and there's more oversight around you. You just have to make sure that you're running a clean ship.
No, absolutely. But in terms of, Hasib, this was something I want to ask you as well, specifically actually. How do you hire people? Like, how do you go first, number one, identify the right person for your team and culture? And then how do you, how is this decision made?
I think it depends on at what stage you're at, because you're going to attract different people at different stages, and different people are going to be appropriate for different stages as well. I think in the beginning, you're really looking for people who are just dreamers and at the same time, just very, 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 very high on the curiosity aspect.
Okay.
That are self-learners, like very, very strong on the self-learning skill. Because, as a founder, I think both of them said this, and I said this earlier, you have to be involved in everything. But then so does the first 5 or 10 people that you hire. There are no boundaries at all, right? And you need to have people as well because they have high curiosity, they also have to have very, very low ego, because there's a lot of stepping on toes, right? And so lots of humility over there. So eventually then as your company scales, you see whether those people are actually even scaling with the company as well. And that's when sometimes I think some of the harder decisions are in terms of how to coach people out of the company. Sometimes they go on to find new adventures. They really love that 0 to 1 stage, and so they might find another. And then I think when you get to, let's say outside of that 0 to 1 stage, you're kind of getting to, I'm just making stuff up, but 1 to 10.
Yeah.
Then your hiring process about how you do that at a scalable level. So let's think about from 15 to 45 employees. That becomes really, really important. Actually being very, very deliberate. Because the first 10 people are the people that you know. They're probably people you've worked with before. You're kind of going through your trusted network essentially. But then after that, it's about building a really, really good process. And I think over there, one thing that you have to, at least what I've really learned is, before even the job goes live, you've already kind of architected what the first 30 days look like, who that person's really going to be working with. You've kind of thought about what they have to achieve within 90 days. And then you run that process and you run it all across. You get people that you trust from a culture point of view to be at each of those stages, because as you're understanding both functional as well as culture aspects, you're building a bit of a report to tell you what are the flags to watch out for in that probationary period. Because I think one thing that we struggled with in the early days of Creditbook is understanding how to make a keep or leave decision within 90 days.
Okay.
Right? And I think we've gotten a lot better over there.
Have you hired bankers?
Omair is the closest thing that we have to.
I was thinking, but is he really a banker though?
He's not a banker.
I mean, from HSBC days, kind of a thing, right?
I didn't know that.
Yeah, he was doing risk at HSBC.
Okay.
But yeah, he shared a lot of that.
No, he's not a banker anymore.
No.
But Omair could be. He could work in those really highly structured places as well, or at least you can tell that he has. But so Omair, in terms of your hiring practices, what is there any actionable advice that you would give?
Case studies. When I say case studies, I mean, so if you're coming in at a certain role, I want you to be able to show what you're going to be able to implement. So I almost asked people to come in and say, okay, assume you have started yesterday. Present to me what you're going to be able to do in the next 3 months, for example. And it really gets me to understand their thought process, the way they function, their drive, and that's been a good filter mechanism for us because some people, it was interesting, and here specifically, so the amount of people that will come in and say, I really want this job, and I'm like, okay, can you go away and just do this small exercise for us, come back in next week and present. The amount of people just fall off that cliff right there and then, and you never hear from them again. Like, what, I have to do work before I join?
Yeah.
Like, cool. You're
No,
out.
I get that.
You're out. So then once you have, and literally the conversion from that to is like maybe 10%. 10% of people
Saves
will
you so
actually
much
come,
time, yeah.
will actually do the work. Now there's then those who come in and do like a terrible job of it, and you say, okay, not going to happen. And I think over time, the other aspect which we've done is group buy-in. I think early stage, we made a mistake of either I would endorse someone or Ali would endorse someone or someone else, and then we'd bring them in, and it just was not the right fit. We didn't get kind of, at least from the senior manager level, we didn't have a group buy-in, and that caused friction and problems. And so those are a couple of things that we've done to try and sift through. But look, we're still learning. I think we still make mistakes in hiring, senior and junior, and we're just constantly trying to iterate the process as we grow.
Another question I wanted to ask you about was going multi-market. How's that decision taken? Like, and when I see a lot of founders who, like, in the early pitch, they don't even have a lot of customers, and there's this whole vision of being in like 7 markets in like 4 years. So you know that won't work really. So how is that decision made, and what's that framework like when you're thinking about, okay, this is the right market to go to?
So never early stage. So focus on being able to know that what you've built is something that people want. Show scalability to a certain degree. I mean, we're still not at scale in Pakistan. Still have a lot of room to go. And then for us was, okay, can that be replicated in another market with a very, again, it goes into like MVP. You almost have to go back to being like a founder at the beginning. Go and test that other market as cheap as possible.
Okay, same thing.
Yeah. Same thing. Do not spend a lot of money because your board will push back. They push it back on us. When we said we're going to go and do UAE, for example. Like, what are you doing? We invested you to do Pakistan. I said, give me 3 months. So he went, tested it very simply, and spent next to no money, but very few people there, and we were able to prove that we were able to do it. So I think the only way you can validate it is by testing it out. Be truthful to yourself to understand what are the parameters that you define success or failure. And then if you are successful, then you can go after it a little bit stronger, and then you have backing from your investors and the board to be able to go after it. So, yeah, I mean, and for us as well, I'd say the big aspect was the parameters of Pakistan. As much as I think we will continuously grow over here, and we are right now, operationally and growth-wise, it's important for you to diversify outside the country. Because growth equity capital for Pakistan alone, I don't think will be here anytime soon. And so
By growth equity capital, you mean those Series C, etc. Like
not even C.
B, or even
I mean, even A.
Even A.
Even
wow,
A.
okay.
Remember, look, at the tail end of the cycle, letters got. Yeah, it was like
You had no
alphabet
idea.
soup. It was reaching for, oh yeah, this is my C. Like, no, you're not the C company. So I think it was alphabet soup back then. Now, realistic A. A is going to be very tough for people to raise in Pakistan. So, and it's unfortunate. I think that the opportunity is clearly there, but and you can either, similar to how I said at the beginning as well, when coming in and saying, yeah, I'm going to borrow from the banks because it's the way it's done in other markets. You've got to be realistic about your market.
Yeah.
And I remember when we went through the Endeavor process, in fact, part of the screening committee of one of the rounds were these 2 Egyptian companies, which built basically similar businesses as us in Egypt. And they both had large exits, one larger than the other. One stayed just in Egypt, and the other one stepped out of Egypt very earlier on than you typically would. So year 3. So similar to us, year 2, 3. Much larger exit for the person who stepped out, and both of them, despite the other one having stayed in Egypt and grown a big business and exited, both of them said, step out of Pakistan as soon as possible.
But, fine. But the way to do it is still like
0
to 1. Like as if you're launching a
do
new
not
product.
risk the mothership. I think the biggest what we've seen happen, and a couple startups, this has happened from Pakistan, they've went and chased Saudi, for example. Saudi is a very expensive and very difficult market to enter, and it's much slower for you to enter. So what they did is they built something here, which was doing decent, not 100%, it still had tweaks to go, but because they said, oh, everyone's being able to raise for Saudi, I guess I got to go do Saudi, they jumped to Saudi, spent a lot of money, and they risked the mothership.
Yeah.
So then they ran out of capital because they overspent over there. Then they had no more capital for over here. And then they went back saying, oh, what do we do? And investors are like, all right, shut down. We'll write it to 0. So I think what you have to be is realistic and say, look, I'll go test it out, understand whether you can, how much it's going to cost, how easily can you go to market and bring revenues in the door, get revenues as quick as possible. The moment you do that, you can say, okay, fine, I'm willing to go and put a little bit more money into this to be able to scale it. But otherwise, don't risk your core business by stepping outside.
In terms of, like you mentioned, like determining success and failure as well, at the early stages, how do you guys define the metrics for success? And how do they evolve over time? Or do they evolve over time? Or like, is your core business always the same, so your metrics would always remain the same? Like, or do they change with time?
Well, I think in the beginning, you're always obviously looking at milestones. Get the product ready, get X amount of banks on it, have the next product ready, get X amount of banks on it.
Yeah.
Because as a fintech, that's what you're worried about. But immediately, I think once you become commercially operating, then you start looking at very specific metrics on what's your throughput, how much are you deploying in terms of financing, profitability, cross margins. Then you start looking at these. I think probably around maybe 2-3 years down the road, you started to look at different metrics. But in the beginning, it was really just getting the product out and, oh, these are the steps I need to take to make sure that the product works. Because when you're building a payment system where you want to debit every bank and settle any bank on the same day, 3 times a day, you have very specific plumbing jobs to complete. It's just a sort of a fintech is just a glorified plumber, right? You're just trying to connect some banks together and just have to make sure that your first milestones are always sort of like a PMO function where you're just running a project management office, making sure you're getting the product ready. But immediately then, once you become operating, it's about how many distributors, retailers are actually using your platform, what is the daily throughput, how's the financing rising, all of those things. Then you start looking at very different metrics. And I think it's every company has their own evolution of metrics that they might create for themselves, perhaps.
Yeah.
Internally, you create your own semantics of how you're going to measure your own performance.
Yeah.
I think one thing that we should, like, as entrepreneurs do, like in the early days, and then again, as your business evolves, like, one like Omair's you have multiple verticals now, right? You have the EWA side, you have the invoice factoring side, etc. But it's just like translating your business into an equation, right? How does your business work fundamentally? And then by seeing that equation, you'll actually identify what your North Star metric is, right? And no matter how complex your business is, it can be distilled into an equation because you earn money and you spend money, and you can actually translate that into an equation and understand all of its parts. And then you come up with your North Star metric, and then that can cascade down into your company. And you can start caring about, like, for example, at Creditbook, it's, we care about, like, our North Star metric is loans processed. We care about some stuff that's happening on the capital supply side. We care about, like, where the origination side is happening. And then we have all of our products that kind of come under that. And then we're looking at the funnels at a more micro level. But it all cascades back up to the North Star. So translate your business into an equation, and then from that, it'll reveal what your North Star metric is. It'll also reveal what are your key inputs. So if you care about, for example, cost of borrowing and cost of capital, you might see that with more volume, you'll be able to bring that down. So you'll be able to understand each component of your business and how to understand the levers to your business, I would say.
Do you have any thoughts on this?
I think I agree that it evolves over time. I think one thing that stayed constant for us is cohort retention. So that's something we follow and track religiously.
What is cohort retention?
So cohort retention means your first 100 customers, for example, that you've brought on, how many of those on a monthly basis are repeating? And it's very important to track that. And by the way, the best of best companies, for example, Facebook, not Meta, their cohort retention is like 45 to 50%, right? So meaning of 100 customers in the following month, that's considered high. That's considered six. So that's like, so it's not 80%, 90%. It's literally sitting at those levels. So tracking that and optimizing for that constantly is something that we focus, because that drives everything else. Because if you got churn happening on your cohort, why are they churning off? That means it's something problematic with the product. Have they just shut down if they just want it? Or is it something that you need to be instilling and changing from a product perspective to be able to bring them back in? So how do you improve that retention again going forward? So that's something we track across all our markets for both ends, B2B and B2C, which then funnels into everything else.
Fair enough. Okay, so final question, and I'm mindful of everyone's time as well. If you are a 22-year-old in Pakistan today, just graduated from university, college, etc., and want to get into entrepreneurship, right? How do you think about this? Like, how do you go get a job first? Do you go dive right in? How would you approach this? And what areas or what opportunities in Pakistan do you think are interesting enough?
I just answered this question very recently. I was invited at a symposium at Indus Valley, and almost everyone answered it in a very different way, and I was the only guy who gave a different answer. Everyone said, try it out, go and dream big and take a leap. And I said, listen, just don't do that. In Pakistan, please don't do that. Learn from someone else, learn at someone else's expense first, get a job for 4-5 years. Unless you have a family business, then just continue that legacy if your parents or your chacha can train you. But if you are starting something completely novel, then it's best that you have some real world experience on someone else's experience. Work in a corporate or work in a startup, work somewhere else and try to understand, at least be big enough to manage a departmental P&L at best before you would take that. That's a conservative advice that I would give to a 22-year-old, that, understand the dynamics of the country first.
Yeah, I'd say the biggest aspect, so one is find a mentor, someone who you just look up to, etc., and just be in their shadow continuously for a period of time. But the other aspect of that and why it's important is a big part of being or starting a company and growing a company is discipline. And I mean, at 22, I don't think I was very disciplined. And you're coming out of university, you're a student, you've enjoyed life, did high school, you don't know what real life is. And the discipline that's required of you, which you only learn through accountability of working for someone else.
Yes.
And again, like you said, family is very different. And you can jump right in there because the family will make sure you're disciplined. And that's a very different psyche that's there and it's privilege. It's amazing the kind of the education you get of being from a family business owner that you just will not get from school is second to none, right? But if you don't have that and you're privileged, go and work somewhere. Learn discipline. Understand what it means to be accountable. Make mistakes on, like you said, on someone else's dime. Because if you make a mistake on your own dime or investor's dime early on, it's painful. You don't even know how to deal with things. There's a maturity that's required to build a business because it's a painful process. And so, that'd be my advice as well. Don't just jump into the deep end.
And if you were, say, a bit older, which space would you get into in Pakistan?
If you were a bit older.
Yeah, so say now you have acquired that discipline, etc. So you're 30. And now you're like, okay, because a job isn't cutting it, let me get into, start an entrepreneurial venture.
Yeah, I'll get Unilever distribution. Or I'll grow wheat and rice.
Okay, you said wheat, sorry.
Wheat. Yeah, wheat. So I'll grow wheat or rice, or I'll try to get a distribution for like Lux soap or
so trading,
all-purpose
etc.
milk or something like that, or become an importer.
importer, not an
Yeah.
exporter.
I'll become an importer. That's a joke. I mean, I think there's so many sectors that are very exciting and overlooked. But if I were to pick something now looking at the landscape right now, I would still want to remain in the fintech sector, but I would also want to look at regulatory technology as well. I think eventually, as we are sort of hamstrung by IMF programs and OECD and World Bank and Asian Development Bank and all of these multilateral agencies that are telling us how to run the country, I think there's a very strong regulatory technology play over here. So there are definitely some use cases that you can develop within that space. I know you've been thinking about some things as well, but there's definitely a lot of compliance tech and regulatory tech, soup tech, that really excites me.
See, but also the first part of the
Yeah,
question.
I mean, I agree with everything that Omer Bhai and Omer have said, which is, look, I think when you want to do entrepreneurship I think it's a respectable endeavor regardless, right? Like I think it requires a lot of hard work because you are the person that's accountable, right? But if you want to do it in a materially meaningful manner, then it is looking at a space that you feel very, very connected to, and you have a lot of curiosity. And before starting something, that's where I agree that you need to find a mentor in that space. You need to cut your teeth in that space, and you need to professionalize yourself. And then over time, as you get some reps in, I would still say don't jump into entrepreneurship. Do it when it is eating you alive and you are finding a gap that no one else is addressing, or you don't believe anyone is going to do it in the way that you think it should be done, or in another way it's said that you don't trust anyone else to do it. Then you're doing it because it's a necessity that you're trying to solve for yourself, right? But then I think the journey in itself is one of the most rewarding ones. There's not an MBA in the world that will teach you what it takes to build a business and how to do it. There's no other substitute for it. So that's the romantic aspect about it. But I think the fundamentals are build up curiosity. Again, when you're 22 years old, hopefully you have a wide lens on the world.
Yeah.
So get into all of those spaces, but then start to narrow your focus and then find a mentor, work in an industry, understand the ins and outs, see the gaps. If it's really gnawing at you and no one is addressing it, no one's addressing it, it's taken a year and nothing has happened, then go out and do it.
All right. Thanks a lot, guys. This was excellent, and I actually kind of got to learn quite a bit. I know you guys, all of you personally, but I think this format helped bring out a lot of stuff that I knowledge that I did not get earlier. But thanks so much.
Cheers.
Thank you.
Thanks.